Welcome, welcome. Get started here in a minute or two. Go ahead and share my screen, always the fun part. So hopefully everybody can see my screen. Those of you who've done this in the past know it sometimes can help if I can get some hands up. Let me know you can hear me okay and see the screen. Let's see here. All right, thank you, thank you, thank you. We're going to give about another minute. We will get started here today. Got a big group for Memorial Day week. Thought everybody be on out of town. I'm sure you're all dialing in or on your phones from the beach somewhere nice. Didn't want to miss this particular topic, I'm sure. So, all right. Well, I've got 12:01. We'll go ahead and get started. So I am Bryan Clontz, president of Charitable Solutions. We're going to talk about shiny and drivey things today. Charitable gifts of precious metals, jewelry, vehicles, sort of all the things within the tangible personal property space. So a couple housekeeping notes. Many of you who have attended before know all this, but I will say it briefly, and that is we will send out a recording of this next week. Would love for you to ask any questions in the Q&A section here within Zoom. Much easier for us to scrape that, and we'll take the questions from this webinar and then the one from Thursdays, and we'll mush them and then include that as part of the Q&A. So if there are some questions that I'm not able to get to, we will definitely get to those and then send those out again with the recording. You may or may also know too, I think this, I can't remember, our 56th or 57th webinar, we've had to migrate this over to a YouTube channel just because there's so much sort of content, which is great. But the bottom line is all these are free. You can watch any of them at any time, including on your Memorial Day vacations. And that's really it. So again, happy to be with all of you here today. Go through a couple quick sort of things too. Go ahead and click forward here. So some of the things that we do, I'll keep this pretty short. So at Charitable Solutions, I started in 2003. We have always, since day one, tried to help make charitable gifts happen that otherwise wouldn't. That has always been our mission. We have a team of 28 people helping to execute on that as part of the Charitable Solutions side. Have about 140 people or so on the Emergency Assistance Foundation side. And what we do, I'll sort of start there on the emergency assistance. You can see there, we won't go through this much, but we have a global platform that is a public charity that I created in 2010 that does nothing but disaster relief grants and personal hardship grants. Do that, you can see there for about 400, I think it's 450 or so companies now and about 14 million employees. So donors can make donations, get full deductions for that, and then we're able to make grants to impacted employees or otherwise charitable class members who have been impacted by disasters and personal hardships, and those are tax-free. So all this is around sort of, again, the complexity of risk management through aggregation and structure to make these gifts happen. What we're doing today, professional advisor, CE, obviously field CE for other professionals, donors, board staff. Speeches tend to do about 60 to 80 of those a year. More and more, I'm really happy that about half of these now are virtual or webinar obviously based or meeting based, which is great. But also still like getting out there other than all of the plane cancellations, which have been a nightmare the last couple of weeks, doing some of these in person too. So I do a lot of these, and a number of members of our team do these as well. Charitable appraisals. So had 4 or 5 come in today for crypto. So I do all of the crypto and life insurance appraisals. We then have a team that does business appraisals, precious metals, which we're going to talk about today, as well as tangible personal property, obviously talking about that today as well. And so our tagline is, if you can give it to charity, we can appraise it. Usually we're correct with that. We don't tend to do any local real estate for sort of obvious reasons. But anything for outright gifts, life income gifts, or estate gifts that need a qualified appraisal, we only do these for charitable appraisal purposes. Gift annuities. So we talked about sort of managing risk in the two particular areas that are the most risky, and those are non-cash assets and gift annuities. So 80%, if not more, of our firm's effort and time has been around those two areas. So basically you can lose more money than the original gift. So we're super hyper focused in those particular areas. And so we do that in two ways. One is charitable gift annuity risk management for existing pools. So for charities that have pools that have questions about whether sort of sort of maximizing their residuums or sort of the remainder interest, whether they're very large concentrated risks, different sort of policies around minimum ages, minimum sizes, different types of assets, and so on. So I've always had an actuary on staff. I do this work as well. I'm basically stress testing gift annuity pools, trying to answer any questions that the charities have. And then National Gift Annuity Foundation is where that's more of the outsourced provider. So to the extent that the charity doesn't wish to take on a particular donor based on their policies, maybe it's not in a state that they're registered in, it's a different kinds of asset that they're comfortable with, very quick turnaround, very large gift, sort of anything, getting back to our core mission of helping make charitable gifts happen that otherwise wouldn't. You can see there we're in all 50 states and have now, I think it's real close to 1,100 contracts, gift annuity contracts. And then most importantly, 100% of the residuum is then granted back to the charity or charities that the donor was trying to give to in the first place. So we're really just a giant intermediary for these types of gift annuity donations. Do the same thing with CRTs as well. So being able to manage that risk through a very large pool and then through the structure that we have, so that basically all of the risk, literally, not basically, literally, all of the risk is ours and not the referring charity. So we've had about maybe 350 charities that have referred in gift annuities that for whatever reason they were not, they didn't have a program. They were shutting their program down. Again, they were not in New York or California or Hawaii or so on. And then finally, same kind of thing is helping make gifts happen around the non-cash space. That's what we're talking about, obviously, today. But I will say 99% of what we do is not related to tangible personal property, which is what we're talking about today. But I will say that probably, I don't know, maybe 15-20%, 1 out of 8 calls that at least I get are around some kind of tangible property. So we get tons and tons and tons of calls about it. And then once they realize, they being the donor, the charity, or the advisor, much of the complexity that we're going to talk about today, in many cases, don't move forward. So this is primarily on the Decami Foundation side around private business interest, off the chart number 1, real estate, crypto, and so on. So you can sort of see the rest of that. Bottom line is we tend to do roughly 1 of these donations per day. You can see we've completed over $5 billion now in assets, 100% of which were initially declined. The charities then most always then refer over to us. If we complete the gift, we then grant back to them, subject to donor advised fund policies, obviously donor recommendation. You can see there roughly the average fees tends to bounce between about $1.2 and $1.3 million, with an average donation around $5 million. And that's been pretty consistent the last 3 or 4 years overall. So I'm not going to spend much time on this at all, but these are the actual donations we received in 2024. Again, does not include CGA or CRT activity. The one thing in a weird way I want to point out is what's not here, and it's not tangible personal property. So out of 288 donations, I think it was 0. This can get a little funky because sometimes tangible property might be inside of an LLC or other type of asset that we hold. For example, we took in one very, very expensive baseball card that got super sideways and was sort of a horrible gift on a number of levels, which I won't go into, but I think that actually technically was inside of an LLC. So to the extent we actually would have received that and kept it, again, longer story for a different day, that would have actually been included in the LLC. But bottom line is, you see here sort of the other things on the bottom. That's normally where these would fall, at least for us, from our perch. Clearly, a museum is going to be very different. There are a lot of universities in the Midwest that do tons and tons and tons with ag assets, in particular crops. That's tangible property. So obviously different charities with different perches see more of these than we do. But we've done a lot of things. We've done multiple gifts of wine, a number of very high dollar artwork. We did a Picasso, I think, 2 years ago, not super expensive, a De Chirico, a Munch. We've done crops, and so all kinds of things that we're going to talk about today we've actually done. But the point is, and I say this with love, a lot of charities get really focused on sort of the what I call sort of the the drivey things, shiny things. Let's talk about gold, let's talk about this, let's talk about that. It's like good. That may be like 1% on a good day of what we see, at least from a transactional point of view. Again, super consistently, weirdly consistently, it's about 70-80% of what we see are these private business interest gifts. I'll use my pointer and everything here, private business interest gifts. And then another 10-15% would be real estate. Again, crazy consistent. Last year, really weird, not consistent. Crypto, over $100 million in crypto. But again, that's very unusual. Usually it's less than 2%, sort of in normal years, whatever that is. So just again, want to provide that as a framework. So here's what we're going to talk about today, right on time. So tax consequences of tangible personal property donations. And so these are, and I put in the little blurb that I sent out, and this is actually true. I'd rather deal with that Irish S corporation with aardvarks in it. You think that's a joke after about next 15 minutes, you're like going, oh my God, I had no idea. Than a bag of coins or any kind of other sort of tangible personal property. Super complex area of the tax code. And it's also important to note this is an entirely separate section of the tax code just dealing with tangible personal property. So it is so understandable to be sort of empathetic here to donors that will call and say, hey, I've got X, shiny drivey thing, and I know how it works. I'll get a fair market value deduction for that, and the charity put it to good use, because that's just how stock works, and that's how crypto works, and that's how real estate works. I'm sure that's how this works too. And then you have to say, let's come on, sort of back onto the boat here, and let's sort of go through this educational, painful process about how tangible personal property works versus all these other areas that we normally see in the charitable giving space. Talk about the weird rules, and they are weird in history. I should say weird rules and weird history of coin and collectible donations. That's the shiny thing. So we'll talk about those too. The weird rules, and they are, and the weird history, and it is, of vehicle donations. Half this stuff you can't make up. Then talk about what I hope is maybe the biggest nugget of the day here, and that is sort of the math around goals and objectives for why fair market value deductions may not be best. And so it's so difficult that these conversations are shut down quite quickly, in particular by the CPA, in particular, when they may realize that they're not going to be receiving a fair market value deduction. It's like, oh, never mind, let's move on. Like, whoa, let's go down sort of an alternate path about what might work, not necessarily relative to the deduction, but a lot of other benefits. So going through a specific case study, literally, that we took in last week, that hopefully will help illustrate that. And then for you as nonprofit professionals and professional advisors, sort of what are some of the key questions? These will branch like if-then, like you cannot imagine. Like you just, man, the if-thens on these things. So these are what I'd call sort of the core questions that I would ask. And then based on those answers, then you start all the branching. I only have one slide. I'm not going to do all the branching. So the point here is that these are incredibly complex. Why? Because we're going to play little mini exception bingo. So as I go through this, I'll say, and this is how it works. But there's an exception with an exception to that exception, and then another exception. So you've got just so many layers, and a lot of this is quite amorphous or opaque as it relates to how something would be categorized or defined, and how that might change over time. And any of these little changes then have direct implications on potential taxation, potential substantiation, all those types of things. How many can you count? So we'll see at the end. And then, like always, we do these free webinars. We love you. Nobody's paying for anything. Don't sue us. So almost, and I guess I think this is fair to say, that sort of in the non-cash world, at least what we deal with every day, things like S corporations in particular, I would call sort of the deepest into the Olympic pool. A bag of coins are right there. And so more than almost any other webinar that we do, really, really verify the information with the donors and obviously much more specifically with their advisors. So these are just so, so unique, so many subtle nuances that can have very material consequences. So I obviously really want to emphasize that. So are you ready? Here we go. So exception bingo, we'll start with that as we go through. So, but whenever I get a call, and I think this is so, so important too, the only reason I'm actually doing this is I would say in the last 30 days, minimum 15 calls, minimum about a shiny or drivey thing, minimum. Ryan, my partner's on the phone today. I didn't even ask him before, but I'm sure he's getting these same calls. Laura on our team, Russ on our team, Gary on our team, Paul, they're getting all these same calls. So I thought, wait a minute, gold, super, super high price on gold. So we're getting some of those types of calls, and there's just so much misinformation because it's crazy complex. Thought that this would be helpful. So this is not just a, hey, I'm looking for something to talk about. This is hopefully being very timely. If I'm getting those calls, other charities are, because we're only getting referrals from other charities anyway, so they must be getting the same calls. So with that, let's start. Bum, bum, bum. So we've got tax consequences of tangible personal property. So what are these? How does this work? So tangible personal property, we're going to also define it right out of the gate. So what is it? If you can pick it up, and I can say there if you're super strong, and throw it at somebody. So you can heave artwork at people and hit people in the head with coins and jewelry, and you could pick up wine, I guess. You may not want to throw it, you may want to drink it first, but you could throw, wine bottles at people, and so on. So anything, you can touch it and you can move it. If you can touch it and move it, tangible property. Here's where this gets super weird right out of the gate, at least to me, maybe only to me. So crops in the ground, real property. Crops that have been cut, harvested, personal property. Boom. Within 2 seconds, it goes from real property to personal property. And you might think, oh, that's like wheat. Yeah, but we've also done a number of timber deeds. Timber on the stump is real property. It's affixed to the earth. You can touch it. You're not moving it. But wait, it's now been cut. Now you have timber off the stump that generally becomes a state issue. That's another exception. Don't put that in the bingo quite yet. But anyway, you've got state potential issues, and then whether it's capital gain property or ordinary income property, that's a whole other matter. So you can see here, just like right out of the gate, how it's defined and what it is. And people say, oh, vehicles, you can touch it. And again, if you were super strong, you could move it. That's tangible property. So tangible personal property, obviously different than real property, obviously different than intangible property, royalties, patents, copyrights, and so on. This is tangible personal property. So everything we're going to talk about today, the shiny things and drivey things, all fit in within this, but crops aren't shiny or drivey. Wine's not shiny or drivey. All of these are sort of falling in under these same rules. So as we go forward, and I don't have a real good, actually, maybe I do here. Yeah, if there are any questions, again, if you can include those in the Q&A portion, I will do my best to sort of take a look at those. And I've got a couple of people, I think, on my team that might be able to answer some of those as well. So next one is we'll talk about, let's see, click. So now we've got the definition, like what these things are. And here, I think most all of you know this, but we're going to be very specific about what it means then to donate these to a charity. So there are two different ways of donating these to a charity, or I guess I should say categories. If I were to donate any of this tangible personal property to a charity that can put it to a related use, that is hyper defined in the code, a related use, basically furtherance, you can see there, their exempt purpose, Generally, got to put the word generally in there like 18 times. Generally, that creates a fair market value deduction for the donor. Assuming here, obviously, fair market value is greater than basis. So fair market value deduction. That's what everybody thinks. And that's what everybody thinks. When I say everybody, a lot of professional advisors do too, by the way. A lot of people who are charitable professionals do as well. And certainly donors think, well, that's just how it works for everything. I've got this art. I'm going to give it to Boys and Girls Clubs. I know the art's worth $50,000. I'm going to take my $50,000 deduction. This is going to be so easy. This is going to be so easy. Anytime anybody says that, you know, it's never going to be easy. And then you say, well, not exactly. What do you mean? Well, if the charity cannot put it to a related use, also noted unrelated use, relative to their exempt purpose, then there's the first exception, then they are not able to get a fair market value deduction unless fair market value is less than basis. So whatever their cost or tax basis is in the property, technically it would be the lesser of fair market value as determined by an appraisal. Donors love doing that, by the way, especially when they know fair market value is less than basis. But you still have to get a qualified appraiser to complete a qualified appraisal to prove that basis is greater than the fair market value. So I'm going to go through a couple examples, and it gets very confusing. So what if I gave a painting to the museum? This is the typical scenario, painting museum, and they hang the painting, and their exempt purpose as a museum generally is the public display and education of art. I'm like, oh, okay, they're going to hang the painting, everything's good. And so almost always they would get a fair market value, they being the donor, fair market value deduction. That the charity would then be completing the Form 8283, saying they're going to put it to a related use and so on. All fine. What if you gave the same painting to the same museum and they said, this is great, we're going to have a silent auction in the spring and we're going to sell it there. Oh, this is going to be so good. Now we're only going to use the proceeds from the silent auction to buy more paintings for our collection. And then you would say, okay, that makes sense. Sure, I'll make that donation. Auctions are not the exempt purpose for museums. So that's going to be a lesser of fair market value or basis deduction. Almost always, pretty much always, but I'm going to have to caveat everything here. Pretty much always. So people say, well, wait a minute, it doesn't matter because their exempt purpose is also to acquire art. Yeah, but not with your piece. So if they're doing an auction with your piece, that is not putting that specific piece for related use. Now, if you gave that same painting to the Boys and Girls Club, and I'm saying this very generally here, by the way, you'd say, oh yeah, that they're not a museum, therefore that's not their purpose. Well, it could be, I'm making this up, there could be an arts appreciation program or class very specific to that Boys and Girls Club that they actually have some programming around, and maybe again a class might be around that, and maybe it's to help at-risk youth better appreciate art. There was actually a private letter ruling around it in a CCRC, so a continuing care retirement community, that said basically if the executive director who really liked the art pulled it back into her office, basis deduction. That's unrelated use. But the CCRC's mission was to improve the quality of life for everyone in their community, in their building. And therefore they had art that would help improve the quality of life. And again, maybe have a class around that, some kind of appreciation and display for their residents. Then that was a fair market value deduction. So you can see here very, very quickly, there are a number of slippery slopes that all seem to be gray. So get very, very good counsel. But the key point here is the general rule, any kind of tangible personal property, and again, we're going back to the shiny things and drivey things, if given to a charity, that can put it to related use, typically better deduction. There is an exception to that. Then you'd say, well, okay, then if I'm a donor and I'm doing this, I can make this donation unless, exception number one, I am a active trader, business, or dealer. So now maybe I'm an art dealer and I am, my business is selling art and I've got some extra inventory. When I sell that art in my inventory, that is ordinary income deemed active trade or business. Now, the second it becomes ordinary income, even if I'm giving it to the museum, very, very likely, not giving tax advice here again, very likely, now my deduction will be the lesser basis of fair market value again, because now it's not capital gain asset. Now it's ordinary income asset. This also, by the way, could be an exception that if I'm giving this art to the museum and I've held it for less than a year, now all of a sudden that short-term gain, that then would be the lesser of fair market value or basis deduction. So we've got a double exception within the exception. Can't make that up. It gets crazier. There's another exception. What if I am a farmer, cash basis farmer, can't make that up, cash basis farmer, that I donate nutritious crops. That is also legally defined as to what a nutritious crop is. And then also I would have to be able to make that donation to a humanitarian relief or food charity, so food bank. Now, actually, even if I might have depreciated in essence or expensed off all of my cost of production of that crop and my basis is zero, even though it's ordinary income because I'm actually a farmer, this is my active trader business, there's actually an exception to the exception to the exception to create a unique benefit, very interesting, by the way, for me to take either what's called ugly crops or perhaps just past prime crops and donate those to food banks and other charities that can use them. Now I actually can get an additional a deduction based on fair market value as a percentage. It's a percentage of fair market value, 50%. So I'm digressing. I get it. But I really want you to understand when people say, oh, how hard is it to give, a painting or crops? Like, well, here we go. It becomes the if then plinko. How long, if you've held it for more than a year, if you've held it for less than a year, if this is going to related use, if it's not going to related use, if it's going to a charity that, or coming from a donor that otherwise would deem this ordinary income property versus not ordinary income property, unless there's an exception to the exception relative to things like, as an example, this is one example, this nutritious crop exception. So just to give you again, and this is not a joke, I think I've got maybe 18 of these bullet points. We're on number 3. So when we talk about, I'd rather deal with the Irish Aardvark S Corporation or Irish Corporation. You're starting to, I think, get a really quick sense as to why that's true. Then there's another exception. What if the donor is actually the creator of the property or had received the property from the creator by gift, devise, or bequest? What does that mean? That means I am a modern day Picasso, which I am not on a number of levels, and I paint a painting. And that painting is worth $50,000. But when I painted that, what is my cost basis? My cost basis is the cost of the materials. What does that mean? The painting, the actual paint, I should say, the paint, the canvas, and the frame. That's it. If I sell that painting myself in the first year or after the first year, held short-term, held long-term, 99% of the time, that's going to be ordinary income because I'm the painter. That's my active business. So if I then give that, to the museum, so I'm the person, they're going to put it in their public display and education of art. Everybody's happy, clearly related use, but I am the actual artist. My deduction now is limited to basis. It is not fair market value. So then, as I go through this, by the way, there are going to be a number of ways that people try to game stuff. Super clever to me, super clever. People can be, especially advisors, can say, wait a minute, what if I did this or what if I did that? And then usually that works pretty well until the IRS is like, wait a minute, that seems like tax fraud. And then they sort of clamp down, generally speaking. So what does that mean? That means I'm the son, let's make up, my daughter. So let's say my daughter's like, well, I didn't create the art. I say, well, you did not create the art. How about, wink, wink, I give you the art. You're not the creator. I give you the art for $50,000 of value, and then you donate it to the museum. Gotcha. Because now we're going to get a fair market value deduction. The IRS says, no, 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 no. If you got this through again, a bequest, if you get this through, unless there's a step up in basis and so on, or by gift, then again, it's going to be as if the artist made that donation. So here's the exception to the exception to the exception here as well. Now, there's also a deduction exception if the property is put to related use. So now they're saying, yes, we're the museum. Yes, we're going to hang it. And then 2 years later, like, we want to sell it. And you should know this. Everybody should know this. Kind of a big nugget. What are you going to talk about it? The worst kept secret there is I think this is actually the right number. Somebody, if they know the number, put it in the Q&A side. But it's something like 70 to 80% of all museum collections are actually in storage. So when collectors take these, I've, curated my 15-piece Renoir, collection, whatever it happens to be, and we're going to take this to a museum, and they're going to love all 15 pieces. If they take all 15 pieces, unless you give them like $1 billion or something, they'll take anything. That is like a miracle on top of miracle on top of miracles. Because what they're going to say is, I want one. If you're lucky, they'll take one. They're not taking 15, because then they're going to have to put storage, insurance, upkeep, all that kind of stuff for 14. So my point in all of this is I shouldn't say a lot, that's not fair. A number of these pieces are coming out late. We want to use it now, but now we've got an upgraded piece and now we don't need it anymore. Or somehow we're going to sell the piece. Less so, by the way, with paintings. There's a whole other, regime around sort of the National Association of Museums, Zoos, and Aquariums. Kind of a weird group, if you ask me. And sort of whether you sort of what it means to accession a painting into the permanent collection versus deaccessioning paintings, and lots of ethics around that and PR and blah, 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 blah. But you get the point. The point is that at the moment I gave my tangible personal property to this charity, and they say, yes, we're going to use this for related use, and they actually do it, that if there's any time within that 3-year period they stop doing that, they sell or otherwise dispose of the property, then they actually basically have to let the donor know, hey, we're no longer using this, and now there's a recapture for the donor because they took a deduction that was at fair market value. They basically have to recapture that income tax deduction to basically affect it at basis. So that's not complicated at all. And I'm sure charities are just super tight ship related to these types of triggering mechanisms when they sell or otherwise dispose of these types of assets. That's a whole discussion for a different day. I have never heard, I'd love for you guys to put this in the Q&A or chat. I've never heard of a charity actually selling or otherwise disposing of tangible personal property within a 3-year period and notifying the donor. I'm sure it's happened. But I'm also sure, given charitable turnover and the complexity of these laws and reporting and everything else, that these things might have otherwise been sold, and that has not happened. I don't think that would be too much of a reach. So who knows? So that's an exception relative to the deduction. Fair market value going in, and then wait, oops, it not related use during the full 3-year period. Therefore, the donor has recapture. All right, so now we're down to, all this was just based on fair market value deduction related to related use. Now we have a whole other area, which is unrelated use. So if it's not related use, what does that mean? So that the charity cannot put a property to related use, and then the deduction is, again, the lesser of fair market value or basis. Now, again, it could be that they put it to a fair market value use. It's still the lesser of basis, again, if it's a active dealer, active business or dealer, or if it's the original artist and so on, or original creator, I should say. This is not just for art. So if somebody otherwise creates, jewelry, which I guess is an artistic sort of expression, or anything, they're actually creating it themselves, creating that value. Could be, I don't know, putting a kit car together or something. I don't know. that might otherwise be deemed sort of the creator. So anyway, again, it extends beyond just artwork, though that's the easiest to sort of think about. Then there's another exception. What are we up to now? Is it like 8 exceptions or 10 exceptions? It's got to be. That the charity can provide, in this case, a written statement. This goes back to the issue of, wait a minute, we took it in for fair market value because it was going to be related use. We had to sell or otherwise dispose of it within a 3-year period. Oh, I'm sorry, you're going to get a basis deduction. There's going to be recapture. Wait. There's an exception to that the charity can provide a written statement that has to have very, very specific things outlined, that under the penalty of perjury, that said it was impossible to continue using the property for related use. And sort of here's all the evidence as to why. And then if that's the case, basically the IRS is saying, yeah, sort of beyond this, the dominion control or control of the donor, and perhaps even beyond the control of the charity, that for whatever reason that this could not otherwise be used, and therefore, wait, you don't have to have any recapture there. So you can't make it up. But that's, again, very specific. I've cited the potential code section there that includes all of the specific elements that are required to get that relief, in essence. And then now we're back to fair market value deduction. I didn't do a good job of formatting that, so you can't kind of read the back, but or read the bottom of it. But when we talk about this, it has to have a qualified appraisal. And you might all go, oh, we know how that works. You do, but also in particular for artwork, there is, if it's over $20,000, the entire appraisal must be included with the tax return. For all other sort of non-cash assets, pretty much all other, it's $500,000 above. So right out of the gate, that's sort of letting you know the IRS going, we don't kind of like these sorts of gifts, and we want to sort of have a little bit more oversight and monitoring. There's actually a whole arts advisory board that reviews these appraisals. That's a whole other conversation for a different day. And sometimes most people would say it's sort of a best practice or good practice to include like a photo of the art included with the appraisal. Sort of is usually not required to do that, but the IRS can request it. So if they're going to request it, might as well just include a photo unless you're trying to hide something, and so on. So the point is that you still have to have a qualified appraisal. What drives donors nuts is let's make up that I am one of these antique roadshow people that I walk in and I'm like, wow, that kind of looks like a Picasso, but they're saying it's not a Picasso, but it kind of looks like a Picasso. I'm going to give them $100. And then what do you know? It was a Picasso and it was worth $1 million. So my basis is 100,000. The value is $1 million. So now I am going, and I'm going to, let's just make up, give this piece to a different charity. Now my math isn't perfect here, but you'll get the point that it's not going to related use charity. It's going to another charity, cannot be put to a related use. So if I even want to take my $100 deduction, now nobody's going to want to take a $100 deduction. I'm going to switch up my math again, doing this on the fly. Let's say I paid, weirdly, $10,000 at this garage sale, estate sale for this. $10,000. I was like, wait a minute, that's kind of material. I do want a $10,000 deduction. And I understand my deduction will be basis. I still, as a taxpayer, have to go out and hire a qualified appraiser to complete a qualified appraisal on the property. And the donor's like, are you insane? I know it's worth more than $10,000. It's worth $1 million. This is crazy. I still have to go out and get a full appraisal. Yes, you do, because technically the deduction is the lesser of basis or fair market value. So you have to prove through the independent appraisal process, qualifying appraisal, doing a qualified appraiser, doing a qualified appraisal, that fair market value is greater than basis. They go nuts. Now, there's another thing here I was just going to tease out. I talked about people being clever. So the first little clever thing people did, as I mentioned, was you go to the artist, the original creator, and said, hey, you give me the piece and then I'm going to make it a gift to charity. And oh, we just gamed the system and I'm getting a deduction that otherwise you couldn't. That was clever gaming number one. Clever gaming number two has actually come up to me maybe 3 or 4 times in the last 4 or 5 years. And that is where this sort of active trader business dealer. And what this is a very complex area, but what somebody could do is say, wait a minute, I could go and buy artwork from a whole bunch of different artists and like huge volume. So I'm going to get a really big discount if I'm buying lots of volume of pieces. Maybe it's 5-10 cents on the dollar type stuff. And this happens. It doesn't have to be just with artwork. It can be any kind of tangible personal property. But artwork, this tends to come up more than not. So I'm going to go and I'm going to buy a big volume. Then I'm going to wait a year. Then I'm going to try to find charities that will accept sort of these as one-offs, and I'm going to get a full fair market value deduction for this. I didn't get it by gift from the artist. I purchased it from the artist, just at a very low relative to market value price. So the IRS is super keen to this. And they basically say, if they see that, they can basically apply this whole active trade for business or dealer definition. And they've actually done that. So there's been a couple, I think, revenue rulings and some other things where they basically have attacked that whole strategy of, it was almost like these huge conservation easements that people are doing, the syndicated sort of conservation easements, not the same, but kind of the same, where you're basically trying to aggregate larger groups. So anyway, that's sort of another clever thing I was going to just sort of call out here too. Wait, we're not finished. This is just page 1. Here's slide 2. Tax consequences part 2. There'll be more exceptions you should be very excited about. So you can also give fractional interests of any kind of tangible personal property. What does that mean? And I know we keep talking about paintings here because I just think it's easier for people to think about. But this, for any kind of tangible personal property, these sorts of concepts are almost always, with some exceptions, the same. So in this case, you could say, wait a minute, I have this painting. I'm going to give the charity, a museum perhaps, 50% irrevocable interest in the painting, a fractional interest. But they have to take possession of that painting and actually display the painting, use it for their related use. For me then to be able to get an irrevocable deduction, I cannot have more than a negligible sort of reversionary right in some way of that painting. And then I'm not even going to go through this, but the Pension Protection Act, August 17, 2006, instituted an entirely new sort of tax regime for how these types of fractional gifts work. I put on there crazy complicated rules. They're crazy complicated relative to the appraisals initially, appraisals for any additional fractional interest gift. Maybe I give another 10% in 3 years. What is the appraised value at that point? And then how long do I actually have to be able to give the entire interest? So there was also, when I talk about cleverness, there was some real, I would say, clever tax gaming prior to the Pension Protection Act that allowed people to hyper calibrate what their deductions were based on these fractional interest donations. They could spread them out over a super long period of time. They could get sort of higher deductions later. A number of pretty cool things you could do that the IRS is like, yeah, this is kind of getting a little bit out of control. We're going to sort of really pin it down with these new sort of set of rules. So now we've been talking about most of these relative to outright gifts. What are these relative to charitable remainder trusts? So if you give to a charitable remainder trusts, you do not get a fair market value deduction ever for a charitable remainder trust donation, because that's actually not a charity, as you know. And most always, which is super weird to me, a couple of private letter rulings on point were actually tangible personal property given to CRATs, charitable remainder annuity trust. Why you would ever donate these to a CRAT, I have no idea. Very strange to me. But if you're ever going to do tangible personal property, you want to do those into a NIM-CRUT or a flip-CRUT. It gets weirder. The deduction is not captured when the donation goes in. The deduction is captured at the time the tangible personal property sells. And then that's still on cost basis is the deduction, lesser a fair market value or cost basis. And then you would calculate the cost basis times the remainder factor. And then that would be the deduction that is received. Gift annuities, really weird. A gift annuity is a gift to the charity. So could you make a gift of a painting that a museum wants to be able to acquire and that they give you a fixed payment as long as you live and get a related use fair market value deduction? Yes. Yes. So a gift annuity can work really well, if the charity who's issuing the gift annuity, is going to be the direct issuer, wants to acquire that piece for related use. Past law said, this was super weird to me, past law said that the donor would have to have a reasonable expectation that the charity would put it to a related use. Now there must be actual use. So it's gone beyond, yeah, I expect that they will hang the painting versus sell it. Now it's like, no, they're hanging the painting. Public display as an example of art. Charities must comply with Form 8283 and 8282. This also gets gamey, where it has to be for a single item or a group of related items. So a lot of donors think, wait a minute, if I've got to trigger this at $5,000 and I have to do a qualified appraisal, oh, I know, I'm going to make a donation and claim it at $4,500 for this particular piece. And then I'm going to do the same thing again for this piece that's $4,500, and then another thing for $4,500. The IRS generally, what is deemed related items or like-kind property, that's a whole other conversation for another day that's very complex. But they would come in very likely and say, wait a minute, this is all from the same collection. These are same similar pieces. Therefore, you're supposed to aggregate. And once you aggregate, now you're supposed to have the appraisal again. So you can't sort of come in just under the wire every single time and go, oh, I've pulled one over on the IRS. I was able to sort of gain that. That happens a lot too, by the way. The charity must sign Form 8283, attesting intent. This is the weirdest thing I've ever heard in my entire life. We are attesting that we intend to do something. So on Monday, when we receive the painting, as an example, I keep using paintings. When we take in the painting, I'm attesting that we intend to use the painting for next week, or for the next 3 years. And then next Tuesday, well, I don't really intend to do that anymore. Now I'm going to sell it. So that gets weird. You can see there, my kind of joke is get the intern to sign that. You're attesting intent, and interns will sign anything. You just tell them, oh, no, this is like for HR. Like, oh, I don't know. You get the intern to sign it. I don't like signing those things. So if you're trying to do related use, you're attesting intent, and then you have to put it to actual use, then subscribing to the additional compliance you have for that 3-year reporting period relative to recapture. Unless, again, exception again, that could not otherwise be used for that original purpose, and it was impossible to do that, and therefore you have the relief potentially. Critical point. This is a big one. Big nugget. A lot of donors just want to avoid the ordinary income or the collectible capital gains taxes. No donors know this. A lot of CPAs don't know this. Capital gains tax. If I have long-term capital gain property and I sell it, what is my federal tax rate? 20%. It is for everything other than collectibles. Everything other than collectibles. Collectibles, that was never changed. So a lot of what we're talking about, if they're deemed collectibles, are still at the 28% federal rate plus additional state. So a lot of donors are really just trying to avoid that in a big deal. Okay, so we're going to move through the rest of this kind of quickly. So this is weird rules and history of coin and collectible donations. So what is a coin? That's a whole other conversation. Is it sort of cash, if you will? I know that's not a coin, but you get it. So it's like, is it a $100, sort of piece or $10 piece, like a bill? Is it a collectible, like from the Etosha sort of shipwreck? Is it national deemed currency, which prior private letter rulings that you can't rely on have sort of deemed that to be akin to cash, but yet other potential unissued private letter rulings seem to take a different position relative to that? The ones, at least, that had positive letter rulings were Maple Leafs and Krugerrands. You can see that private letter ruling there. Cannot make this up. In 2001, 2001, a taxpayer was concerned, saying, well, there are these private letter rulings on Maple Leafs and Krugerrands. They're not on American Eagles. Clearly, that's national deemed currency, but nothing was clear about whether it was tangible property or a cash equivalent, in essence. So the taxpayer submitted at that time much less expensive, less costly private letter ruling request, and said, look, I'm going to give American Eagles to this charity, please rule. And it seemed as though, and the commentator said, it seemed as though the IRS started taking the position of, no, we're actually starting to think this is more tangible personal property, therefore not a full fair market value deduction for the gold content. People are like, oh, that's not going to be good. Then the taxpayer, the petitioner, died in the middle of the ruling. You can't make that up, which immediately expires the ruling. Therefore, we still don't know, two big questions, would American Eagles be deemed akin to cash as national deemed currency? And we're also kind of nervous about, were they actually going to go sort of against the prior rulings around Maple Leafs and Krugerrands? But everything else is a collectible, or unless it's an inventory. Now I'm a coin shopper. Now I'm a dealer. Now the whole collectible thing went away. Now it's ordinary income. This is crazy complicated, crazy. And especially when we don't even know if our own national, American Eagles, we don't know what the deduction would be. I mean, that's crazy. So if anybody wants to spend the 40 or 50 grand to do a private letter ruling, I would appreciate that, but we still don't know. Then, even if you figure that out, what is the value of the coin? Is it the denominational value, the number on the coin? Is it the numismatic value? Oh, it's from the Atosha. It's super pricey relative to a collectible. Or is it the intrinsic metallic value as of the date of the gift, based on the, let's say gold content or silver content? Those all change based on what the coin is. Are precious metals like bullion bars created the same way or treated the same way as coins? Generally, they are not. That's all automatic, auto tangible personal property, which then falls under related use rules. So the gift of the Atosha shipwreck, you might know, it was Fisher, I think, was the one that found that shipwreck. He created his own museum. Well, now he's got his own museum, so that would be, all things being equal, fair market value deduction, because now it's part of a museum on display, which was the exact purpose, I'm assuming, of the museum. But bullion, different. Now you've got ETF investments with underlying tangible, that's tangible property. That confuses everybody. No, Brian. These are ETFs. These are publicly traded. They are publicly traded, but inside those ETFs is tangible bullion. And that tangible bullion is deemed tangible personal property. So that's going to flow through. And now we're back to related use rules and non-related or unrelated use rules. What about collectibles like art? We've already talked about that a lot, but unique considerations about that, but also would otherwise be antiques, wine, jewelry, are all subject to tangible personal property tax rules. Again, crops, any of those types of things. And then collectors, again, very important, can be, we'll say, and I put ... sort of the ellipses there, unique. They can be very unique and very emotionally tied to collections. So we see this a lot sort of with collectible donations more generally, especially with artwork or other types of sort of things that they have sort of personally curated, and they know the story behind each one and so on. That creates a whole other sort of a bit of noise overall. What about vehicles? So now that was the shiny things. That shiny things, now we got drivey things. So drivey things are, what are drivey things? Well, it's your uncle's pickup that he hasn't driven for 42 years. These are the craziest things ever. These are these duck boats. So they're a horrible and unsafe car, and they're a horrible and unsafe typically boat, but people seem to jump in them for some weird reason. Then this thing, the craziest thing ever. This is actually supposed to come out this year. So this is a flying car in China. So the Xpeng is it's a helicopter car. I mean, you can't make that up. And this one is the best thing ever. This is a prototype. This is a boat and a car and a helicopter. So that would be a really cool gift to get. But you get the point, is that this is anything with a steering wheel, anything. Cars, boats, planes, tractors, against combines, anything. Pre-2005, the deduction for this crazy thing would have been what's called the Kelley Blue Book scam. And that would say is, hey, my car's got 32,000 miles on it, or 145,000 miles on it. And Kelley Blue Book says that in fair condition, that gets fun about how people are defining their own condition of the car. Fair condition, this thing's worth about, I don't know, $3,800. So it's under 5,000. That's good. So I'm not going to have to do an appraisal. And so I'm going to give this to charity and get a $3,800 deduction. And anybody driving anywhere pre-2005 on any highway and across this entire country would see 87 billboards about donate your car to charity and get a deduction. That was the Kelley Blue Book scam. So this was donated to a charity. They never took it directly. It was a third party, basically wrecker, would go out and grab it, take it to a scrap metal dealer. They would melt it down or mush it or whatever they do. And then the charity would get $187. That's kind of an exaggeration, not that much, or go to auction or whatever. But the donor is getting a $3,800 deduction. The IRS said, we don't like that. That seems like fraud. So now we're going to say the actual sales price. That becomes in essence, the deduction. There are exceptions, unless the charity is able to sell that to a needy individual at below fair market value, or, another exception, substantially improve the value and or used it in its own charitable operation. So I know some of these flights that are used to take food and things like that, people donating airplanes there, boats for perhaps like a sailing charity, as an example for at-risk kids, those types of things. So there's a specific nasty sort of publication that goes through what all the additional compliance components are. So it has these two here, you can see them, but 1098C, how quickly that needs to be done, who's signing that, all those types of things. But then it's still subject otherwise to other tangible personal property rules. So we have, in my 35 years, I have never, ever, ever taken in any kind of vehicle until last week. So last week, it was actually a little bit, when Ryan is on the phone, he handled this whole thing. But this is a case study around a specific vehicle that I think is really, really helpful, I hope. So this was an individual, I'd never talked to him, anything else, but very, very charitably inclined. We sold it literally last week for $880,000. I thought it was $840,000, Ryan, but I guess $880,000, which is good. I don't know what the basis was, but roughly when these were new, like $350,000, $400,000 were the basis. So a donor like this would call, I'm not saying this specific one, but would call and then would say, hey, I've got this car, I'd like to be able to make this donation to charity. And would say, well, unless you're giving it to a museum option one, you're not going to get a fair market value deduction. So how would that work? Let's imagine that the appraisal was $880,000. Would donate that to a car museum that they would display, not sell, that they would display, not sell within a three-year period, that'd be a recapture, would create tax savings for the donor of roughly $400,000. Okay? Most everybody would think, oh, that's the better way to go. I'm not saying it's not the better way, but there's an alternative way. Or he donated it to our Decami Foundation to create a donor-advised fund. He's super, super charitably inclined. All the proceeds are going to be going to a UK charity that helps people with disabilities around accessibility and assistance type programs, which is fantastic. And so in this case, he would make the donation, which he did. Tax savings, I'm making numbers up here, roughly $150,000. Well, that's a whole lot less than $400,000. $400,000 is a lot bigger than $150,000. I know, but keep going. And we sold it last week. Let's assume for our fees, their fees, I don't know, that there's $850,000 left. Now he has that in a charitable bucket that he can use for all of his current and future charitable giving. A ton of donors like that concept, ton. And most importantly, if this is deemed ordinary income asset, maybe it was inventory, then there's no recapture or capital gain that he had, or gain recognition he had. Or if it was a collectible, no 28% plus state capital gain. So all that is non-recognition of gain, ordinary income or capital gains. I really want everybody to really think about this, because it doesn't always have to have a fair market value deduction for these gifts of tangible personal property to still work well, assuming the donor's goals are to maximize overall charitable giving, perhaps beyond a specific museum or something similar. So want to make that point. And finally, last one here is, what are the questions? So what exactly are you considering as a donation? What is a conservative value of the property? I hate to be bad whenever I talk to artists, like, it's $20 million. Like, okay, how many have sold for that? Well, none have ever sold, but it's definitely worth that to me. It's like, okay. So there can be a number of issues which we deal with from time to time with ivory, in terms of obviously the saleability of these things, provenance issues, things coming out of Middle East, out of China, number of issues coming up there. So not only what is the value, is there any kind of issues, and that's my other considerations, but who legally owns the property, where is it, and what are these sort of other considerations that we ought to be aware of? Have you discussed the likely tax consequences with your tax advisor? Because I don't usually like having to go through 40 minutes, which it is 30, 40 minutes, going through every single one of the things that I've just talked about today. That's why I'm going to start pushing people to this webinar in the future. That's kind of why I did it. There you go. I will admit that. Because they're all so unique and there's so many exceptions and there's so many interpretations or decision points that are murky. What do they think the tax consequences will be after that conversation? Oh, I know. I'm going to give the car to the donor advised fund and get a fair market value deduction. So then right then I'm like, okay, they have not had that conversation or they're not getting good tax advice. And do they understand the appraisal rules? Do they want the charity to use the property in some way? I want to give my plane to an international relief charity that will use the plane for its purposes. That's totally different. There's some cool ways of being able to give cars, as an example, to trade schools where they're working on auto mechanics. Well, that's a wonderful gift, fair market value related use type gift. But the charity has to obviously be able to accept that. How do they wish for the property to be sold? This one is super challenging for those people who are emotionally connected to the piece. If it's gold, and we actually use a dealer that we work with a lot, he's able to do all the transportation, insurance, all the shipping is insured, all that kind of stuff. Get that sold and we're just getting the proceeds. That's great. I literally had a conversation here, and I know I've got about 1 minute left, literally with a donor that said, I have 3,000 antique playing cards, the biggest collection in the world, Guinness Book of World Records. And he said, and I want to give that to you. It's worth like $2 million or some big number. He said, but I want you to sell only about 3 to 5 packs of cards. Yeah, 3,000, 3 to 5 per month on eBay. That's how you're going to maximize the proceeds. I'm like, I'm a math guy. My great grandchildren will still be selling this stupid stuff on eBay. I'm not doing that. So a lot of this is more around sort of the best, dealer to use. We like absolute auctions, which is what we did the car with last week as an example. But has the charity considered all of these other issues, the storage, the management, the tax reporting, compliance, maintenance? You get a plane, you better understand maintenance and the feeding for a boat around slip fees and all this stuff. Tons and tons and tons of these, big nugget, tons and tons of these types of assets the fair market value is lower than basis anyway. So why are they trying to give it away? Because they can't sell it. We can't sell it either. We don't want to have all the carrying costs either. So a ton of these, the donor should just sell it him or herself. And that's my conclusion. I hope you've had this weird and very, very complex exceptions to exceptions jaunt here through the shiny and drivey things. Here are a lot of the other webinars that we've had in the past. And definitely get any Q&A that you put in. I'll be able to combine that with Thursdays and be able to get that out next week with this free recording. So I wish you the best of luck again with shiny and drivey things. Hope this has been helpful, understanding more of the complexity, but also other resources that are available to you too. So thank you guys very much.